Thanks, Tom, and thank you to Isabel and the team at Mining Journal for inviting me to speak here today. So I cover cobalt and cathodes at Benchmark Mineral Intelligence. For those of you who may not have come across Benchmark before, we produce price and data analysis on lithium-ion battery supply chains. Primarily, the business was set up to produce prices, so we do that for lithium, which is quickly becoming kind of the industry reference price going into contracts, cobalt and graphite anode materials. We also provide forecasting out to 2040 for the minerals, and we're involved in a number of different large consultancy projects. We gave testimony at the US Senate last year, involved in with governments, mining companies, finance, etc., OEMs, vehicle manufacturers. So today I want to talk a little bit on kind of the macro view of the cobalt supply chain with reference to batteries, what's happened in pricing, really looking at kind of what's going on now, why we've seen the recent downturn in pricing in cobalt, and then moving on to what's happening with battery production with a focus on Europe and a global view. Finally, wrapping up with cathode technology changes and the implications for cobalt, what are the wide-scale implications of these changes of technology. So I put this is a very basic sketch of the cobalt supply chain in its most simplistic form. I put this up to kind of remind you that when we're talking about batteries, we're talking about cobalt chemicals and not the metal that we see commonly referenced in terms of pricing in the media. And it's a different supply chain. So really largely speaking, the material that goes into batteries starts here in the DRC as intermediate products, which are shipped to China to be refined into the chemical form of cobalt. And then as we get to this red section here, further downstream towards the cell, we see some of that capacity go elsewhere, particularly Japan and South Korea. So onto cobalt mining. The DRC dominates cobalt mine production. As you can see, last year, 66% of mine material came from the DRC. You know, and in the media, we see a lot of discussion around supply moving away from the DRC, and I agree that's important and will happen in the future, but ultimately there will be no lithium-ion battery industry without DRC cobalt. We actually see the DRC becoming more significant in the supply chain, so some big additions coming from Glencore's Katanga or Komoto, ERG's RTR project in the DRC, and Shemaf have a Musonoi refinery that they're building in the DRC as well. So rising to 74% of global production by 2021. But that is inherent with risks. I mean, even if it wasn't, but any country that controls so much of the supply chain, no other country contributes as much as 10% towards cobalt production, would be a red flag to investors and the industry alike. But also with the DRC, there's an added geopolitical risk of its historic instability. And also we've seen recently some big changes in mining royalties in the country that happened very quickly and dismissed previous safeguards. So there are a number of concerns by those in the industry about continually sourcing from the DRC, and we're seeing the industry move towards reducing their geopolitical risk and investing outside of the DRC. So if you have a project, you're in a very strong position if it's outside of the DRC. And we're starting to see capital committed now. So I've put a number of deals on there, the most recent being Silver Wheaton and Cobalt 27, doing a streaming deal with Vale for the Voisey's Bay mine expansion. But even with these expansions coming from new projects, as well as in the DRC, we still think there's going to be a cobalt deficit looming from 2022 and beyond. So between now and then, we actually think there'll be enough material to source, to feed the industry, but this big deficit looming in the future. Now moving on to refined supply, China dominates cobalt refining. So 58% of the world's cobalt was refined in China last year, but as I said, cobalt chemicals and not the metal going into the battery, lithium-ion batteries. And China actually produces 80% of or just over 80% of the world's cobalt chemicals. So China has a real stranglehold on that part of the supply chain. There's only one major producer outside of the DRC, and that's the the other large portion of the pie then, that's Freeport Cobalt and their refinery in Finland. And we're seeing significant expansions going on in China at the moment of up to 10x. So again, becoming more dominant in that section of the supply chain. We've seen a slow global response elsewhere. As I said, China is expanding. We've seen some talk of cathode facilities within Europe. Umicore recently said that they would have a cathode plant in Poland. But really, in terms of refining capacity, there's not much going on outside of China. And why is that a concern? I think many of us will know that the Chinese government have set some quite strict new energy vehicle targets in terms of penetration rates. And whilst in the near term, that may not necessarily present a problem, but as we approach 2022 and material becomes more scarce, cobalt that goes into China, will it be used to serve domestic markets before it's exported for the rest of the world? So there's a concern there as well. And what's happened in pricing. So I kind of want to talk a little bit more about what's happened recently, why prices have been going down. I think everyone knows in 2017 the reasons behind price rises, primarily, obviously, demand, but also some speculator interest, and also impact from kind of a lack of intermediate products going into China. So the larger chart here is the benchmark cobalt sulfate price, and this is the kind of chemical feedstock that goes into the battery supply chain. And more recently, we produce a cobalt battery metal price. It tracks the metal products that are most suitable for chemical conversion and going into batteries. Now, as I said, 2017 prices ran up, but we've seen this decrease in prices more recently following Q1 this year. Now, if you were speaking to a Chinese refiner, they would say, well, demand is very low, you know, things are bad. But I don't actually think that's the case. I think that's only looking at a very small part of the supply chain. Now, to some extent, the EV ramp-up in terms of production hasn't happened as quickly as many thought, but it's still happening very quickly. The figures are very strong. But really, I think this started back last year. At the very end of last year, we saw a change in payment terms within certain parts of the supply chain, which meant you were paying upfront in one part of the supply chain and getting cash after delivery under normal payment terms further down. So cash flow was impacted very heavily. At the same time, we saw the prices run up in Q1, which was linked to metal tightness and not actually anything to do with the chemical market. But that has an impact on raw material feed prices going into China. Now, the two combined meant that buying patterns were impacted, so there was less buying going on in China and gave a general feeling that demand was low. But it wasn't that demand was low, there's just very little cash flow. Equally, at the same time, Chinese banks became more tight on their lending. So it created this bearish sentiment, and that's why we're starting to see some of the cobalt chemical prices come off due to a lack of buying. But I think it'll be relatively short-lived, and it's something that we're monitoring closely and looking at sentiment. And it just goes to show, with some of these smaller commodity markets, sentiment is as important as demand. So, battery mega factories. Back in 2014 at Benchmark, we noticed a trend in the way in which battery plants were being planned. They were going from megawatt-hour scale to gigawatt-hour scale, so an order of magnitude bigger. At the time, there were 3 plants, Tesla Gigafactory being one of them, LG Chem in Nanjing, and then Foxconn plant, which didn't happen. Now, this is where global megafactory capacity was at the end of last year. A megafactory is a plant with a capacity, or a plant capacity of bigger than 2 gigawatt hours. This is where we were last year. And this is where we're going by 2023. So really significant growth in terms of global battery capacity, of lithium-ion battery capacity production. Now, where is that located? So probably no surprises, largely in China. And you can see there the rest of the world. But again, this is in terms of actual capacity rather than number of plants. China, again, leading the way, nothing surprising there. But I should add, in China, it isn't all Chinese-owned companies. This is also JVs, particularly with Japanese and Korean companies. But we're starting to see the emergence of Europe as a new battery hub. So I want to take a look at that a little bit more closely now. Before I do, though, I want to talk a little bit about what's happened in global battery strategy. So up until fairly recently, battery companies tended to have a strategy of having either one very large plant in one region or country or a number of smaller plants in the same region or country. The company that didn't follow this trend was LG Chem. So LG Chem actually, from very early on, decided to build plants, one in every major center. So they have their plant in South Korea, they have one in China as well, in Nanjing, Poland, in Europe, and Michigan in the US. And we're starting to see that this might be the strategy going forward and companies starting to follow suit. So GSR Capital, a Chinese company, bought AESC, which was Nissan and NEC's battery company at the end of last year. They're also planning a plant in Europe there, which are in Sweden, that I've marked on the map. But as I say, things are changing. So particularly in Eastern Europe, we're seeing Asian battery companies locate there. So Samsung in Hungary, SK Innovation, which are due to open their plant in, I think, 2019 or 2020 in Hungary as well. And CATL are yet to finalise their location, but Poland or Germany are being talked about. Now, why is that? We think, obviously, proximity to customer is important, some big European automakers, but also we think that from the data we've collected, that battery production in Eastern Europe in particular, the cost is only, in terms of how cheap it is only second to China. So we think it's a cost basis as well, and we're seeing Europe emerge. I've also marked on there Northvolt and Terra E, two new battery companies due to open in the coming years in Europe as well. So this is what's happening in terms of capacity. So last year, very small, just 7 gigawatt hours of battery capacity, we think, in Europe, rising to around 80 by 2023. I've put the implications for cobalt demand in the region there, but this assumes 100% utilization rate. So allow you to do your own research on utilization rates of battery plants. So this isn't a true number. This is so we can make comparisons across different regions. If I were to extend this line out to 2028, we think that would rise to around 175 gigawatt hours of capacity. So Europe, as I say, based on proximity to customer and cost of production, is looking to be an emerging battery center. So what does this mean for cobalt? Now, people talk about thrifting away of cobalt in cells. Largely, they're referring to nickel, cobalt, manganese, but it's also happening in NCA, nickel, cobalt, aluminium cathode type, which is what Tesla use, and almost exclusively Tesla in EVs. So from when Tesla first started putting their 18650 cell in the Model S to current day, we think they've managed to reduce their cobalt dependency by around 35%. And then with the advent of the 2170 format cell, that's the larger format cell that's going to go into the Model 3 or is going into the Model 3, they managed to reduce it even further. So we think around 60% on average over a 6-year period, Tesla have managed to reduce their cobalt dependency. Now that sounds quite significant. Tesla used NCA, which is already a very low cobalt consuming technology. But what I want to kind of point out here, and what's important is the sentence on the bottom there, is that volume of sales is the most important factor in this equation. So between the end of Q1 this year and the end of this month, Tesla expect to increase their vehicle production by 150%. So these reductions are significant, but they're not as significant as the volume of sales going forward. And again, so talking about substitution in nickel, cobalt, manganese, NCM cathode type, when it was originally created, it was even parts nickel, cobalt, and manganese, referred to as 111. As we developed the technology, we've improved energy density, and this has meant the advent of technologies of 523, so 5 nickel, 2 cobalt, 3 manganese, and 622, which are available in the market now. The kind of end goal is 811. I think a lot of people probably will have already heard of that, and why do we want that? So it not only increases energy density, which is a favourable trait to automakers, but also, on the face of it, raw material input costs are lower. Nickel is cheaper than cobalt. But there's a number of challenges around this. So primarily, one that gets talked about a lot is that the cell doesn't last as long as it needs to, or the pack won't last as long as it needs to. Cell degradation, or term the life cycle, how long the battery can retain its capacity. There's the warranty implications for automakers. The average is talked about to be 8 years to retain 80% of its original capacity. If your cell doesn't do that, there's big cost implications in terms of warranty repairs. There's also, I've got on there, additional cost of production. So when you're producing 811, you need to produce it in a dry, inert environment, and there's increased cost linked to this. And then finally, safety. So as you reduce the amount of cobalt in the cell, you reduce the thermal stability, and your thermal management needs to be better. It basically means that at lower temperatures, there's a risk that the cell could catch on fire and combust, which is obviously, there's a number of safety implications around that. So the move to this technology will be relatively slow. This is our timeline. So we think from 2020, we'll start to see early adoption of this technology in China first, and then from 2021 out, international adoption, which will be more slow. So it will have an impact on the supply chain, but it's a little further out than I think people believe. But I want to kind of wrap this up with what it really means for cobalt as a global commodity. So people talk about 811 and this big reduction in thrifting, but what's the implication on the total picture for cobalt globally? So this is for the year 2026. On the left-hand axis, I've got total cobalt demand from the battery sector. So that's all cathode types. That's NCM, which is by far going to be the biggest consumer by then, and the EV cathode of choice. LCO, which goes into your portable electronics and is very cobalt rich, and then NCA, which is the one that Tesla uses. So all cathode types. But then on the bottom here, I've got assumed adoption rates by 2026 of 811, that kind of least cobalt rich formulation. So in the right-hand side here, I'm assuming an aggressive scenario, the most aggressive scenario, where 40% of all nickel, cobalt, manganese cathode produced will be 811. Our base case is 25%, and then assuming the technology, the challenges that I talked about can't be worked out, just a 10% adoption scenario. Now, you can actually see that between the most aggressive and the least aggressive scenarios, there's only a 25,000 ton difference. Now, last year, in 2017, the battery industry consumed around 50,000 tons of cobalt. So by 2026, we're saying it's either going to be between 180 in the most aggressive scenario or 205,000. So again, this is what this takeaway from this slide, what it's saying is that, yes, okay, cobalt is being reduced in cells, but the volume of cells is by far the most important factor in that equation. And I think I'm completely out of time, so I'll just do a shameless plug. Most of the data in this presentation was taken from our Cobalt forecast. If that's something of interest, please come and speak to me at the end or email Benchmark. There's a question there, but that's it from me. Thank you very much.